Hi team, hey, good to see you. Econ Teach NZ back again. Now, I tell you, here we go. What we're going to do, we're going to have a look at part 2 of our monetary history series. And today's topic is going to be when governments break money, the greatest inflation disasters in history. Okay, we're going to have a look at all sorts of different ones, including the Weimar Republic and Zimbabwe, the Venezuela situation. We're going to look at all of that. So, for example, in 1923, you may not know this, a loaf of bread in Germany cost 200 billion marks. Not a typo, 200 billion. Workers were paid twice a day, because if you waited till the end of the day, your morning wages had already halved in value. People literally burned banknotes for warmth because wood cost more than the money itself. All right, stick around. This gets even weirder. Right, keep watching. Here we go. This is hyperinflation, and it is not ancient history. It is not a cautionary tale from a dusty economics textbook. It happened in Zimbabwe in 2008, in Venezuela in 2018, and in Turkey and Argentina more recently than your syllabus currently acknowledges. And every single time the mechanism is the same. There's a government that's under pressure, it tends to print more money than the economy can absorb, and the result is not prosperity. It is the complete destruction of the thing that money is supposed to do. All right, so here we are. Today we are studying the greatest monetary own goals in history, and we're going to pull out exactly what each one teaches you for your exam and for understanding that the world you actually live in. Right, this is this world, right? But first, we're going to do a quick detour, okay? Because before we can understand how governments break money, we need to understand what money actually is. And that answer is a bit weirder and frankly more interesting, maybe than last week's video, It's a Shared Fiction, and the framing of that suggested, okay? So let's have a deeper truth look. All right. Last video, we said that money was basically a shared fiction, a collective agreement that this piece of paper is worth something. It's not wrong, but it's just incomplete. And being a good economist means following the evidence further than the comfortable simplification. So here's the thing that will genuinely melt your brain if you let it. Economists and textbooks have been telling the same story for around 250 years. Okay, humans started with barter, swapped your fish for grain, and then, because barter was awkward, invented money to make trading easier. It's clean, it's logical, it makes total sense. There's just one problem, okay? Both anthropologists and historians have looked everywhere, from ancient Mesopotamia, classical Africa, pre-colonial America, early Asia, and they haven't actually found a single real historical society operating on barter as its primary economic system. Not one. So a famous anthropologist, David Graeber, right, spent years studying this. He has a book entitled Documented in Debt, the first 5,000 years, right? In there, historians dig into ancient records. They find, instead of barter, they find debt and credit obligation, owing someone something, tracking that in memory on clay tablets long before coins were invented. So ancient Mesopotamia, 3000 BCE, right, written records of elaborate credit systems, merchants extending credit and debts being tracked, interest being calculated, and this was all before coinage was even a thing. So the real origin story of money isn't trading was annoying, so we invented coins. It's closer to we were already tracking who owed what to whom, and eventually we needed a standardized unit to dominate those debts in. A lot to talk about. All right, so this reframe matters a lot because it changes what money really fundamentally is. It's not just a convenient token for exchange. It is at its core a record of obligation. And most of the money in the modern economy was created not by the government printing notes, but by banks making loans. So your bank lends someone money for a mortgage. It doesn't go into a vault and count out existing deposits. It creates new money digitally by typing a number into an account. That loan is the bank's asset. The deposit it creates is a liability. Money in a modern economy is mostly bank-created debts. IOUs that circulate, and they're computed, they're just zeros and ones. This is not theory. This is how the Bank of England describes its own monetary system, its own official system publicised, right? The majority of money in circulation at any given time was created by commercial banks extending credit. So why does money not hold any value? Or why does it hold any value? All right? Trust is part of it, yes, but there's something more concrete underpinning it, and that's where we get this idea of chartalism, which does sound like something from a fantasy novel, but is actually one of the most important ideas and underrated ideas in all of monetary economics. All right? So here's the thing. All right? Chartalism, from the Latin charta, meaning ticket or token. All right? We know about tokenization. All right? Makes a very specific argument. The reason people accept government-issued money isn't because of trust or habit. It's because the government has made it legally necessary. You have to pay your taxes, and you have to pay those taxes in the government's currency, not in gold, not in Dogecoin, not in favours, despite what you might see. All right? The specific unit the state demands. So think about what that does. Immediately, every person, every business that has a tax liability, which is almost everyone, suddenly needs to acquire the state's money. They'll work for it, they'll sell things for it, they'll accept it in transactions because they know they need it when tax comes due. The state essentially manufactures demand for its own currency through a legal obligation to pay taxes. All right. Sounds almost cynically simple, and it kind of is, but it does explain something that pure trust framing can't. Why can't you have, or why you can have, a functioning currency, even if trust in the government is a little shaky? People in many unstable countries continue using the currency, not because they admire the government, but because their tax obligations are still denominated in it. And this explains why hyperinflation is so politically and socially catastrophic. Because when a currency collapses completely, people find ways around their tax obligation rather than accepting the worthless money. The state will lose its fiscal grip, and then things get very messy very fast. So let's revise our mental model from the last video. Money isn't just a shared fiction based on trust, it's a system of obligations, mostly debt, tracked and circulated. It gets its basic demand from the state's power to impose tax liabilities in a specific unit. Trust matters, but the legal structure and tax obligation tend to be the floor beneath that trust. Now, with that sharper picture of what money actually is in mind, let's have a look at those inflation disasters. And those disasters are now more instructive. So let's take situation case study 1. Germany, after World War I, was dealt one of the worst economic hands in modern history. Right? The Treaty of Versailles demanding reparation payments, enormous ones. The economy was devastated. The government owes more than it can possibly collect in taxes. So they do what governments under severe pressure do. They printed money. And at first it appeared to work. They were able to pay down their debts in devalued marks. Creditors were receiving currency that was worth less than what they lent. The government's real level of debt and real debt burden actually shrunk. Everybody was feeling, a little bit about it. Okay? But here's where the systems thinker earns their marks. What happened next? People noticed that their savings were shrinking in real terms. So they start spending money immediately rather than holding it, because tomorrow it would be worth less than today. That surge in spending then started pushing the prices up. The government printed more money to keep up with that. Prices rose even faster, so the printing accelerated. You've entered that feedback loop where there is no natural break. So on November 1923, a long time ago, prices were doubling every 16 hours. The exchange rate hit 4.2 trillion marks to $1. So what about our charterless lens on this? The Weimar government lost something more fundamental than just trust. It lost fiscal credibility. The ability to convince anyone that holding marks is useful because there's tax obligations to be met. When the currency became worthless, the tax system itself began to break down. Because what's the point in collecting taxes in money that's worth nothing? The political consequences: destabilisation, mass resentment, the complete collapse of faith in the institutions. And a certain Austrian-born gentleman with a tiny little moustache used exactly that economic chaos as a recruitment tool only a decade later. It's not an economic footnote, right? We can shape politics, we can shape history with this. That connection is real and urgent. So your exam angle, all right, here it is. Your go-to case study for the quantity theory of money, right? MV equals PT, right? This is it. The Weimar Republic is an extreme version, but that mechanism is identical whether you are thinking that inflation is 5% or looking at 5 million percent inflation. Case study number 2, Zimbabwe. This is 2007 to 2009, so much more recent, okay? Their hyperinflation was, and I say this with full respect, absolutely unhinged. The peak level of inflation was in November of 2008, and ready for this, 89.76 trillion percent per month. That's a number with 22 zeros on the end, right? Check this several times. It actually broke my brain. The government would issue a $100 trillion note, which at the time of issue was worth around about 40 US cents. Okay, where did it go from there? Or how did it get there? Land reform policies in the 2000s disrupted agricultural output. GDP collapsed. Tax revenues collapsed. The government needed to pay civil servants and the military. They ran the same playbook as the Weimar Republic, printing money. But here's the detail that your textbook probably misses, and this is where genuine data interrogation will get into that information. Zimbabwe's collapse wasn't just about the printing, it was a simultaneous collapse in productive capacity. You can't inflate your way to growth if your farms have stopped producing. Your industries are shutting and your most skilled workers are emigrating, leaving, flying away to neighbouring countries. And critically, from a charterless framework, when your currency becomes hyperinflated, the entire basis for its demand evaporates. Even the tax system had to switch to demanding payment in foreign currencies because the Zimbabwean dollar was effectively useless. The state had lost its own monetary anchor. The eventual fix, 2009, Zimbabwe abandoned its own currency and started accepting US dollars, South African rand, and the Botswanan pula instead. The market didn't just lose trust, it substituted other states' tax obligations to backstop the value. They didn't pick up gold. They picked up currencies that had functioning governments, real fiscal systems behind them. Sometimes the market's solution to a government's catastrophic currency failure is just stop using the currency entirely. Your exam angle. Right? This illustrates both cost push and demand pull inflation occurring simultaneously, which we hope is a rare and brutal, which we hope is rare, but it is a brutal combination. It also shows currency substitution as an informal market response to a total institutional failure, both of which we can discuss in our exams. Now, some of you are thinking, okay, this is all very dramatic, but there are other places, are there? This isn't relevant perhaps to the UK, to the US, to New Zealand. So let's cast our mind back. Here we go, situation 3, 2021. COVID hits. Supply chains fracture globally. Governments inject trillions of dollars into their economies via stimulus package. The US alone put in more than 5 trillion US dollars. Okay? Demand would recover faster than supply would respond. Then, Russia invades Ukraine. Early 2022, spiking both energy and food prices across the world. UK inflation ends up at around 11.1% in 2022, the highest in 41 years. New Zealand's inflation rate was 7.3%, with the US reaching 9.1%. Central banks around the world who called those early price rises transitory realised that they misread the situation. They ended up hiking those interest rates at the fastest pace in decades. Now, this is not the Weimar Republic, this is not Zimbabwe, but the mechanism rhymes. Okay, excess money chasing insufficient goods. Supply constraints colliding with demand stimulus. Here's the modern angle that most commentary skips. Much of that money injected into those economies wasn't government printed cash, it was bank created credit. That stimulus programs turbocharged. Quantitative easing, the central banks buying financial assets, expanding those bank reserves. And the commercial banks then expanding lending. The money supply expanded through this debt creation mechanism that we talked about earlier. There was too much money, and that money was too much money. It was denominated in debt, and it was chasing too few goods. Right? Too much money chasing too few goods. The key difference between that and the Weimar Republic, institutional credibility. The Reserve Bank of New Zealand, the Bank of England, the US Fed, all of them may have made missteps, but they've actually got decades worth of inflation fighting track records. People broadly still trusted them to bring inflation down. Tax systems still functioning. The fiscal floor is intact. That trust, that institutional credibility, backstopped by functioning tax obligations, is what prevented 11% inflation from becoming 1,000%. And that credibility in and of itself is an economic asset, one that is very easy to spend down and extraordinarily difficult to rebuild, perhaps a lesson for the modern age. This is your real-world application for monetary policy, central bank independence, and the distinction between demand pull and cost-push inflation. It's recent, it's documented, and you've lived through it. Use that. All right, so here's the through line, okay, across every case study we've covered. Money isn't just a vibe, it's a system, mostly bank-created debt, right, denominated in whatever unit the state enforces through their tax obligations, sustained by the institutional credibility that keeps those obligations meaningful. But when that system breaks, through reckless money creation, through the supply collapsing, through the government losing its fiscal grip. Sorry, hold on. The consequences aren't just economic, they're also social and political. Sometimes civilization altering. The lesson here isn't that governments are bad. Right? It isn't that when governments print money, that's bad. Okay? It is more precise than that. Sometimes monetary expansion is exactly the right call. The 2008 financial crisis response probably prevented a full depression. The COVID era stimulus did save millions of jobs. But the question is always, what is the productive capacity behind the money? What is the institutional credibility backstopping that currency? Are the tax and legal obligations that create the demand, are they still functioning? Context always matters. Model critiquing matters. System thinking matters. And now you have a more honest picture of what money actually is. What makes all of these tools sharper. All right, this is Econ Teaching Z. Please like, comment, subscribe. Comment below. What inflation disaster do you feel was most avoidable and why? Make an economic argument. I'll push back on any interesting ones. Please subscribe. It helps with the algorithm. Next week, we're going to ask questions that divide economists and financial bros and your economics teacher potentially. Is crypto actually money? Right? We're going to apply an economic test to it. We're going to be rigorous. We're going to be fair. There is going to be no agenda either way. I will see you there. Hey, Kornera, have a good day.